So again, to remind you that this course is only and only about investment in other companies. And that's all about it. It's only investment in equity in the other company. So in order to purchase the equity, we have two options. Either we're going to purchase the net assets of the company and we're going to dissolve the company, or we're going to purchase the shares of the company. And that way we're going to have a parent and subsidiary. So what we saw is there, before we have a control, there's other forms of investment. So the other forms of investment is when we don't have a significant influence, or when we owe less than 20% of the share of the company, and there's no evidence that we have significant influence. In that case, we have two options. Either we're gonna record an account for the investment using the cost method, or the other one was equity method. Cost method, within the cost method, we have to revalue the investment every time at the end of the period and adjust to the fair value. And the difference in the fair value and the current value of the investment either is going to go to the current earnings, to the profit and loss, either is going to go to the other comprehensive income, which we profit and loss for the other comprehensive income. And that's about it. Now, if we have significant influence, that means between 20 and 50%, then we're going to use the equity method to account for that investment. The interesting thing with the equity method is every time when the company, the other company, subsidiary, the company that we have a significant influence, declare the dividend, that dividend that we're going to receive obviously will be portion of the shares that we own from that company. That investment is going to decrease, that dividend is going to increase our investment. And every time when at the year end, when the company show profit and loss, the percentage of that profit and loss in respect to our significant influence is going to reduce or increase the investment. Now, if we have significant influence, we don't need to reevaluate at the end of each year, unless there's a significant impairment of our investment. And the third method was, the third option was when we have more than 50%, and the 50% is of we're gonna account. So now the investment can be recorded in our books, either cost, either equity method, but for the reporting purposes, we're gonna use the consolidation method. So what that means is we're gonna combine the sets of the statements from the subsidiary and parent on one set. So in order to do that, what we have to do, we have to consider what the parent has, what subsidiary has, and is there any interaction between parent and subsidiary, which most of the cases that happen. And we have to eliminate those ones because we want to show the parent subsidiary as a one entity, not as two separate entities. For that reason, consolidation take place on the different sets of books, not on the parent, not a subsidiary, somewhere different, somewhere outside of the parent and subsidiary. Parent subsidiary is going to still doing the accounting, but consolidation is going to take place somewhere else. Now, once we have that one, once we know that, now what's the option for when one company acquired the other company? The options here are a few. Either the company is gonna, we saw in chapter 3, either company is gonna purchase 100% from the other company, either by buying the shares, either by issuing shares, either by paying cash. And for that, the company is going to acquire the net assets, basically buying the equity of the other company. And then we're going to do this. The first calculation was on the date of the acquisition, to establish how much we paid versus how much the actual fair value of the company is. And if we pay more than the fair value of the company, that means we create a goodwill. If we pay more or less than the fair market value of the company, that means we have a negative goodwill. Negative goodwill, in this case, we're gonna represent the bargain price or something that we pay below the market value of the other company, where the goodwill will simply say that we pay above the market price of the other company. Now, how exactly going to do this? We're going to do this through the calculation. First, we're going to calculate the acquisition differential. Acquisition differential simply represents the consideration that we paid for the book value of the assets and liability of the other company. And excess amount over the consideration that we pay versus the book value, it's going to represent our acquisition differential. Now, that acquisition differential has to be allocated to, first, we're going to use the fair value, simple calculation, the fair value of the assets of the company that we just acquired. And then we're going to see versus the book value, and then we're going to check the fair value versus the book value for all the liabilities of the other company. And if there's a difference, that's where the first allocation is going to go, and the rest of the allocation is going to go to the goodwill. Now, that was when we acquired the company. And then, once we acquire the company, if we have to prepare the report, consolidated report for the both entity at the day of the acquisition, then we're going to take the assets of the first company, assets of the second company, liability of the first company, liability of the second company. We're going to eliminate the investment, because the investment that we have in the other company will be represented by the assets and liability of the other company plus the goodwill. We're going to eliminate the common shares and retainers of the other company, because that represents the assets and liability and the goodwill. Because again, the equity is equal to the assets minus liability. And since on the acquisition date we purchased the assets and liability, that indirectly represents the goodwill. So once we do that, we're going to have the balance sheet at the acquisition date consolidated on one place. That was when we have 100% purchasing the other company. So either we purchase 100% of the other company. Now, the interesting part was in chapter 4, when we purchased the company, but we didn't purchase, we couldn't have enough money to purchase the entire 100% of the company. And then for the presentation purposes, for consolidation method, we have to use either identifiable net assets method, either fair value enterprise method. And that's to account for the non-controlling interest which we have in the company. So since we don't have 100% of the company, there will be non-controlling interest that's going to exist. And that non-controlling interest has to be presented in the first calculation, which is for the acquisition of the company and allocation of the price differential. Then it has to be showed on the consolidation of the income statement, and has to be shown on consolidation of the balance sheet. So those are the two available methods that we're going to use. Either we're going to use identifiable net asset method, either we're going to use the fair value enterprise method to come up with the calculation for the non-controlling interest. So that was on the day of the acquisition. So again, at the day of the acquisition, we have two options. Either we're going to purchase 100% of the other company, either we're going to purchase less than 100%. That means we're going to have non-controlling interest. And we have to see which method we're using in order to determine how much is the non-controlling interest. Now, that's on the date of the acquisition. The next thing that happened is in chapter 5 or last time, we take a look what's happened with the company at the first year of operation after the acquisition. So again, those companies, the parent and the subsidiary, they're going to keep working after the acquisition. And the first thing is the first reporting date after the acquisition. Now, on the first reporting after the acquisition, since we have two options of acquisition, 100% and non-100%, then we have two scenarios here. What we have to do first is, during the period when the parent purchased subsidiary, obviously they start interaction, they start the transaction between those two companies. First thing that we have to find out is on the price differential, book value versus the fair value, and how much we purchase versus the book value. We have to see on that allocation that we created on the acquisition date, is there anything that happened to that allocation of the price differential? First, we're going to take a look at the fair value adjustment for the assets and liability. And if there's any adjustments on the fair value of the assets and liability, we're going to see how much of that adjustment has been eliminated due to the transactions of the company. For example, if we purchase the inventory, on the acquisition date, the company has inventory at the book value below the fair value. Now that inventory was currently sitting in the subsidiary, but subsequently, during the nature of the company, nobody wants to have the inventory, so that inventory was sold by the subsidiary. So what that means is that since the inventory is sold, the price differential is also eliminated. So what we have to do, we have to eliminate that price differential and bring it to zero on the price differential calculation. Second, with the liabilities, if the subsidiary already paid all the liabilities, if there's any adjustment for the fair value versus the book value on the liabilities, we have to eliminate that one too. The last thing that left is on the price differential allocation is the goodwill. Now, for the goodwill, what we said is we're going to test it for impairment. Every year, the goodwill is going to be tested for impairment. The whole objective here is to eliminate the goodwill to zero as soon as possible. And once we eliminate the goodwill to zero, then we're not going to bring it back, even if the value of the subsidiary or there's any circumstances that indicate that the goodwill actually recover its value, we're not gonna bring it back. Once the only thing that's we're gonna do with the goodwill is slowly to eliminate it. That's our objective, not to increase it. Even if the value of the goodwill goes up, we're not gonna increase the goodwill. We're just gonna eliminate it. Now, that's for the first year of first reporting date. Then we're going to have the same thing when the subsidiary, we don't have 100%. In that case, we have to establish and we have to calculate how much exactly is the non-controlling interest of the subsidiary. either versus net identifiable asset method or the fair value method. So once we do that, then we're coming to this chapter, chapter 6. And now we're going to start doing, seeing what else can happen in the company. Okay, we're going to try to amortize and eliminate the price differential. Means that price differential allocation means that any increases on the fair value versus the book value of subsidiary and the goodwill. Obviously, those fair value versus the book value, those will most likely will be eliminated on the very first year. So on the first reporting date, those anything related to the assets and liability will be eliminated. The last thing that left is the goodwill. And then we're going to start seeing, is there any interaction between the both companies? What you have to keep in mind is simply that parent subsidiary relationship is more like a family. What that means? That means that let's imagine we have a family of 4 people. We have a father, mother, and 2 daughters. We're not going to go traditional family, daughter and son. We're going to break the tradition of family. We're going to go with the 2 daughters. So imagine this: each of them have their own income. Each of them has to prepare their own taxes. Each of them have to pay their own taxes. But let's take a look at the family as a family. How much is the family worth? Now, let's establish that the family worth at this point is they have assets of $50,000. They have cash $50,000 and nothing else. Let's keep it simple. Now, what's going to happen if one of the daughters, with the $50,000 that the family buy, purchase a laptop? Well, technically, what's going to happen is cash going to be converted to assets. So the total value of the family worth still going to stay the same, 50,000. But now they're going to have $49,000 cash and $1,000 laptop. Now, what's going to happen if the daughter decide to sell it to the other daughter for $10,000? Now, the first daughter purchases for 1,000. She's selling to the second daughter for 10,000. So the first daughter was going to generate revenue or profit of $9,000. But let's think about what's happened on the family side. Is that transaction between the 2 daughters affect the family wealth? Well, technically no, because the family still have the $49,000 cash and laptop, which is still in the family, for $1,000 original cost. How much was sold from one daughter to another daughter? That's irrelevant because that's inter-family transaction now. Now, what's going to happen if the second daughter decides to sell it to the mother for $20,000? Well, since she bought it for $10,000 and sell it for $20,000, that means the second daughter also is going to show the profit of $10,000 now. But how this going to affect the family? Well, technically, it's not going to affect the family. Why? Because the family is still going to have $49,000 in the bank account and $1,000 laptop, original cost of the laptop. Now, how much the second daughter sold it to the mother, it's irrelevant. When we're going to have, which event is going to trigger change in the family wealth? Change in the family wealth is going to come if the mother now sells the laptop to the outside people. Let's say the mother sells the laptop to the outside family for $5,000. Now, what's happened with the family wealth? Well, in that case, the family wealth will be, if the other family pay $5,000 cash, That means our family is going to have, the family of the father, mother, and two daughters, they're going to have $54,000 cash. And that's all. Why $54,000 cash? Because mother selling it for 5,000, but the laptop was purchased for 1,000, so mother generating $4,000 profit, which moved directly to cash. So now the family has, laptop is gone, but the family has $49,000 originally cash plus the $5,000 cash that the other family paid. So the family have $45,000 cash. Now the mother is still gonna show a $10,000 profit. The second daughter is still gonna show the first daughter is still gonna show $9,000 profit. The second daughter is gonna show $10,000 profit. Mother is gonna show $15,000 loss, but that doesn't affect the family. All those gain and losses between the members of the family, those will be eliminated. Why? Because we're going to go back to the original transaction, which was the purchase of the laptop from the outside, which was originally purchased for $1,000, and selling the laptop to outside, which was sold for $5,000 for the outside. And that's the only thing that we're going to account for. So that's what we're going to do this today. So the parent subsidiary frequently have the sales and purchases, and also other transactions which involved intercompany rent, management fee, interest. When those transactions are not paid, when we're not paying it, those transactions give the rise to the intercompany balance of accounts receivables and accounts payables. So imagine the second daughter never paid to the first daughter, and mother never pays to the second daughter. Right? They're generating profits first and second daughter, but they never realize those profits. So basically, there's no realization. So if the intercompany transactions are recorded in the books of each individual legal entity, so now that means those amounts will be included in the separate entity financial statements and reported on the separate entity income tax returns. So everything that happened on the subsidiary level or the parent and subsidiary level, those entity, they have to report gain and losses and everything. But once we're doing the consolidation, we're gonna eliminate those ones. So however, on the consolidated financial statement, all the intercompany sales and intercompany income must be eliminated against the related purchases or the intercompany expenses. All the intercompany balances, accounts receivables, accounts payable, has to be eliminated. All the income between the different parties within the consolidation is going to be eliminated as well. So which income is going to be shown? Only the income who is realized in transactions to the outsiders, to the third parties. So the company must have a system in place that can capture full information regarding both internal and external sales and purchases in order that the appropriate elimination may be identified. So basically, we're going to rely on the company accounting system in order to see which are the intercompany transactions, how those intercompany transactions are reported within the subsidiary level, and how many of those transactions are actually related to the third parties. And on consolidation, remember, we're going to eliminate any intercompany transactions, profit, losses, accounts receivable, accounts payable, and we're going to leave only the transactions which are related to the third parties, which made total sense. Again, we're looking at the parent and subsidiary level as one company now. What's happened between those two companies? That's irrelevant. Now, the selling company obviously will generate the profit. if we have those intercompany transaction, the selling company, either parent, either subsidiary, they're generating dot profit. Now, those profit, what's interesting with those profit? Let's pretend that, again, let's go to the family. Now, the first daughter buying inventory. Now, she buying, I don't know, candies. That's the candy. So their business is to sell candies. But she's buying the candies. Then she sell it to the second daughter. Then second daughter sell it to the mother. Then the mother selling half of the candies to the outside people. Now, as long as the mother holding candies, which were originally purchased by the first daughter, all the profits related to the unsold inventory to the third parties has to be eliminated. So that will be called unrealized because they are only within the combined entity. And our objective is not, so then they're not objectively measurable. And since they're not in the relationship transaction with the arm's length. Arm's length outsiders means third party. Arm's length is when you put your arm close to your body and that's your length. You're not gonna let a person who don't know to cross that distance. So that's anything who is in the arm's length distance, that's a third party. Everything that is close to arm's length distance, that's a related party. So intercompany sales are likely moving a coin from one pocket to another pocket. And for that reason, it has to be eliminated because the coin still sitting in the pants. If the pants has 4 pockets, you can still moving money from between the 4 pockets, but they're within the same pants. So only the transaction that involved interaction from another pants that will be considered. Intercompany sales, they do not reflect the culmination of the earnings process, and those unrealized profits must be eliminated net of the related income taxes paid. So now on the person, what you have to do, what you have to understand is on the entity level, that entity that's selling or buying and with another entity, that entity is still going to prepare everything that they have to do, financial reports, they're going to do the GST reports, they're going to do the GST, they're going to pay their GST, and that GST cannot be eliminated because that's dealing with a third party. But on the consolidation level, we have to consider it. That's with the inventory when we're doing the intercompany revenue expenses. Now let's see what we're going to do with the intercompany management fee. Now often the parent will charge subsidiary company a management fee. Why? Because they simply want to move profit from one company to another company. That's the easiest way to do it. I don't know if you understand this, but let's pretend that the common thing here in Canada is we have an owner of the company who is the so let's pretend that we have this individual who is owner of the company, and that company is owned by 3 people. So what's going to happen in this case? Now, if the individual enters a shareholder of the company that have 2 other owners, that's going to expose the individual to too much risk. So what the individual can do is individual can open a holdco company which the purpose of the company is to enter into the other company with the other two people. So basically, yes, individual enter in the corporation with the other two people, but he's not entering in that corporation as an individual. He going there as a corporation. Now that corporation, which individual have, which is involved in the third corporation. Now that corporation, what can do is to charge the management fee and get the big company to pay the management fee. Now that fee is going to consider intercompany transaction, and those transactions has to be eliminated. How about intercompany rentals? Well, let's pretend the owner of the company has a vehicle and he renting the vehicle to the company or equipment or anything. So again, if it's within the same parent subsidiary relationship, when we're doing consolidation, those transactions has to be eliminated. Intercompany revenue expenses must be eliminated against each of the other consolidated income statement. Since equal amount of the income and expenses are being eliminated, there is no net effect on the consolidated income. So what's going to happen is on one side, we're going to eliminate the revenue, but on the other side, we're going to eliminate the expenses. Well, those two, they balance each other. So there will be nothing, no effect on the consolidated income. Only revenue expenses which are related to the third parties, to the outside of parties, will be reflected on the consolidated income statement for our purposes. So what's going to happen if we have we have assets? Well, pretty much the same thing. When one affiliated company sells asset to another affiliated company, it's possible the profit and loss recorded on the transaction has been not realized from the point of view of the consolidated entity. So what that means is same thing that I talked in the very beginning. One company buy a laptop and then selling to the other company. Now, since the last laptop is asset, it's going to flow from one company to another company, but since it's not in the transactions related to the third parties, we have to eliminate. If all or a portion of those assets has not been sold to the outside company, we must eliminate the remaining intercompany profits, and we may need to the intercompany loss if there are any on the consolidated income. There's three types of unrealized intercompany profits. Profit on the assets side. On the inventory, non-depreciable assets, and depreciable assets. Inventory, or usually that's an inventory that's used for the purpose of business. Non-depreciable assets, that will be land, and depreciable assets will be anything else in the property plant and equipment section. Anything regarding anything which is not land. And that's how we're going to see those ones. Now, how we're going to treat those transactions now depends how they're going. So we're going to have two options here. One option is downstream transaction. What means downstream transaction? When the parent sells to the subsidiary. So the parent always going to stay on the top, the subsidiary is on the bottom. So downstream transaction, parent selling to the subsidiary. And upstream transaction is the subsidiary selling to the parent. Who defines which one is downstream and upstream? The party that's selling it. If the parent sells to the subsidiary, downstream. If the subsidiary sells to the parent, upstream transaction. Now, When the purchase component of cost of sales is reduced, overall cost of sales will be decrease. When ending inventory component of the cost of sales is reduced, then again, overall cost of sales will increase and the net income is going to decrease. Income tax should be expensed on the same period as the profit, so we're matching the profit with the expenses on the income taxes. Non-controlling interest is not affected by the intercompany profits made to the downstream. So if the parent sells to subsidiary, there's no effect on the non-controlling interest, but non-controlling interest will be affected and will share with the intercompany profit when we're doing the upstream transactions. That's why it's important you to understand which one we're doing, upstream or downstream. So why the non-controlling interest will be affected? Simply because if we have portion of subsidiary that we don't own, that means everything that the subsidiary is selling to us, all the profits that are generating from us, there will be portion of that profit that doesn't belong to us, or that will be related to the non-controlling interest. Let's see how we're doing with the inventory profits. Now, unrealized profits for consolidated purposes need to be held back. What that means? Anything that is not realized yet, hasn't been sold to the third parties or outside of the company, has to be held until it's sold to the third party. For that reason, we have to make adjustment to the income tax, which is related to the unrealized profit needed to be made. So in that case, we're gonna touch the deferred income taxes. Some income taxes are calculated at the individual company level rather than the consolidated income level. So since we know that the consolidation, again, you have to understand consolidation is not make for the purpose of the taxes, for the purpose of making, it's for the making decision, but to better understanding of how many company the parent owns, and once we consolidated all the company, what's the parent worth? That's what it is. But on all the company subsidiaries, they're going to pay income taxes on the subsidiary level. So since the income taxes are calculated on the individual company level rather than on consolidated entity level, the company that recorded profit has to pay the income taxes on that profit. Therefore, the income tax expense on the income statement will reflect that. But since that inventory or that sales of the inventory is still holding by the one of the subsidiary or the parent, let's say the parent in this case, then we have to eliminate the effect. Now, the difference between the buyer's tax basis and the cost of the transfer assets as reported in the financial statement needs to meet the definition of temporary differences. That will increase the deferred income taxes. So now we have a standard, which is International Accounting Standard 27, that states that the profit and losses which result from intragroup within the group transaction should be eliminated in full, but it doesn't say how to be eliminated and how elimination should be allocated between the controlling and non-controlling interest. Now, on the consolidated financial statements, we're going to have direct approach, and we're going to have I believe it was called not a textbook approach, but more like a like a journal entry approach. So the direct approach and the direct approach, we're just simply getting the all elements of the financial statement, and we just simply adding it. Let me take a look on the textbook and find where exactly this one, Exhibit 6.4. Just give me a second to find it. Here we go, I found it. So let me share my screen so you can see it. So what we're going to see here is consolidation of the income statement of the company. Which of the company we have here? We have right from the beginning, we have the parent and we have subsidiary. Actually, this is the income statement of year 4, and we have the parent and we have the subsidiary. We have the sales, so we have the subsidiary sales, both sales. We have cost of sales, we have the miscellaneous expenses and everything that we need. So now we have these downstream transactions which are involved with the cost of sales, so which need to require adjustment of $5,000 because of the inventory that hasn't been sold. So that's the simple explanation of the intercompany transaction. So the $5,000 inventory that we're holding, we have an unrealized ending inventory of 300, which pay income taxes at 40%, so 120 related to income taxes. So unrealized after-tax profit for this ending inventory is $180. So once we have those things in mind, then we're going to start preparing the sales between one company consolidated sales. So we're going to get the sales of the parent plus the sales of subsidiary, and we're going to eliminate the sales of the inventory between the parent and subsidiary. Then on the cost of goods sold, we're going to allocate, get the cost of the goods sold on the parent, cost of the goods sold subsidiary, minus the intercompany transaction, and minus, but we're going to add the $300, which are related to the unrealized profit on the upstream side. Then we're going to get the miscellaneous expenses for the parent subsidiary. On the income taxes, we're going to add, or actually we're going to reduce the income taxes with the $120, which are related to the unrealized profit from the inventory that hasn't been sold yet. On the income statement, on the balance sheet, we're going to deal with the inventory. We're going to add our inventory plus subsidiary inventory, but we're going to eliminate the inventory that hasn't been sold yet. And on the deferred income taxes, we're going to add the portion of the taxes which is related to the unsold inventory. So in order to understand clearly what exactly we're doing here is we have to go slowly through the intercompany profit in the assets. First the inventory, downstream transactions, and we have to see that the cost of the 90% we only own. There's no acquisition differential, as you can see in this case. Whatever we pay is directly allocated, so there's no acquisition differential. Then we having the income statement and the balance sheet of the subsidiary and the parent at the date of the acquisition. Then we see in the inventory purchases, the following inventory transaction happened in week 4. So during the week 4, subsidiary made the sales to the parent amount of $5,000 of the gross profit related to 30%, at the gross profit related to 30%. Subsidiary had purchased those goods from the outside for $3,500. Later in year 4, parent sold 80% of the goods outside for $6,150, and at the year end, inventory contained the remaining goods purchased from the subsidiary for $1,000. Both companies paid income taxes on the taxable income at rate at 40%. And then the first calculation is we have to see, okay, the parent sells for 6,100, subsidiary sells for 5,000. But the 5,000 are related to the subsidiary to the parent, that's the intercompany transactions. We're going to adjust for that. So the only thing that we're going to show is the 6,150 related to the sales of to the third parties. Now, the original purchase price was 3,500 for the subsidiary. For the parent was 5,000. 5,000 are eliminated since that's related to the same sale that goes to the parent. So the inventory that we sold, 6,150, we sold it. The original cost is 3,500. But we have ending inventory, which is 1,000. And that 1,000 is 300 is we have to make the adjustments for the 300 because the 300 we're working with the 30% of here, as you can see, we're working with the 30 gross profit rate. So we eliminated 30% gross profit rate, and we're coming with the actual ending balance amount, which was at the time of the purchase. So once we get that one, we're gonna estimate the cost of goods sold, cost of sales related to the 6,150, and we're gonna have the income tax expense, which we're going to reduce with 120, which is related to the ending inventory, which has been eliminated. And the net income is only $2,100, so related only to the portion of the inventory that has been sold at the original cost of sales, $2,800. And then we're preparing this. So then the next thing is intercompany transactions, how this is affected. And we're going to see the effect of the intercompany transaction. And once we do that, we can start working on the consolidation using the direct approach. So let's go back to the slides now. And that slide here explained the exhibit 6, what exactly happened and how that happened and which one is eliminated, which one is not eliminated. So unrealized profit against are eliminated on the consolidated financial statement. By eliminating unrealized profit, inventory is now stated at the cost of consolidated entity. And when ending inventory is overstated, cost of the sales is understated. Then when the cost of sales increase, then the income decreases and income tax expenses should be decreased as well. And again, from the textbook, that's what we already sold. We're gonna get the sales. We're gonna eliminate the intercompany sales. We're gonna get cost of sales. We're gonna eliminate the cost of goods sold from the parent that's sitting on the parent books, but we're gonna add the 300, which is the gross margin that we the subsidiary charging, and we're going to eliminate the income tax expense, which is related to the inventory that's still sitting in our in the parent warehouse. And that's for the income statement. And for the balance sheet, we're gonna eliminate the inventory that still hasn't been sold yet. We're gonna add the deferred income taxes, the taxes that we paid that what we shouldn't be paying because the profit hasn't been realized yet. And we're gonna come up with the total of the assets and liability and equity. Now, the cost revenue recognition, the matching principle is that adjustment to eliminate the unrealized profits are needed in order to properly apply the cost revenue recognition. Unrealized profit, those are, let me share my screen because you don't see my screen around. So where we were, the explanation started from here, and on the the exhibit 6.4, the one that I just show you from the textbook, we're eliminating all the intercompany transactions, and unrealized profit that always deducted from the selling company, and unrealized profit at year 4 has to be eliminated when they're calculating consolidated retained earnings. Now, unrealized profit again eliminated, and then inventory is now stated at the cost to the consolidated entity. And this is the direct approach preparation of the income statement, the same thing that we saw on the textbook. Here is in the slide. And the next thing is the balance sheet, which you saw in the textbook. Here it's in the slide. So for that part of the chapter, for the intercompany transaction downstream, please take a look at again all the example in the textbook is very detailed explained. So you should be able to see it and understand it. So now the next thing is you have to do the same thing on the new assignment. And I want you to do the assignment because you guys are running out of time, and you have to do the midterm exam next week. Because I can see now the school start pushing me for the your midterm scores. Now, equity method captures only the net effect of the consolidated entity, including the adjustment in the realized profit, and the parent income under the equity method should be equal to the consolidated net income, which is to the parent shareholders. On the consolidated financial statements, how are we going to do this? We're going to take a look in just a second the example of 6 and 7, how to eliminate the unrealized upstream intercompany profits in this case. And then first we have to start calculating consolidated net income. Then we have to calculate the consolidated retained earnings. Then we have to calculate the non-controlling interest. Then we have to prepare the consolidation of the income statement and consolidation of the balance sheet. Those are the steps that we have to follow in this case. So let's start with the intercompany consolidated net income. So the intercompany profits, that's in year 5. Realized profit on the opening inventory. So this means 1 year after the year 4, in year 5. Now we're selling the inventory. Once we sell the inventory, we're realizing the profit of 300, which we're holding in the first place in the previous year. And now we have to pay the taxes, and we have to realize after-tax profit on the opening inventory. So how the calculation of the income is going to be? We're going to get the parent income. Then we're going to get subsidiary income, and we're going to add a realized after-tax income that we just realized it on the inventory that was we're holding the year for, but now we're releasing it. And that's going to give us our adjusted income. Plus our income is going to give us the net income. Now, on the subsidiary net income, since we don't own 100% of the subsidiary, we only own 90%, 10% is going to be income which is for the non-controlling interest or the outside parties which still own the company. That's for the income. Now let's see what's going to happen with the retained earnings. We're going to get our retained earnings. Then we're going to check the retained earnings of subsidiary. What's the current retained earnings subsidiary? Then we're going to check what was the retained earnings subsidiary at the acquisition date. And then we're going to see how much the acquisition, how much the retained earning increase from the acquisition until the year that we're doing the consolidation. Out of that increase, only 90% belongs to us, and we're going to add it to our retained earnings, and we're going to get the consolidated retained earnings. So that's how you're getting the consolidated retained earnings. Now, on the consolidated financial statement, the next thing that we're going to do is we're going to get the common shares of subsidiary, retained earnings of subsidiary. We're going to check how much is the non-controlling interest, and we're going to show that calculation. And then what we're going to do is we're going to get the non-controlling interest at the date of the acquisition. We're going to see the retained earnings that has increased over the years since we purchased the subsidiary. We're going to add the 10%. We're going to add the 10% to the non-controlling interest acquisition, and we're going to get the non-controlling interest at the current moment, or year 5 in this case. Then we're going to start consolidated income statement using the direct approach. So in this case, since we sold the inventory is already gone. That means sales are the sales of the both companies, parent and subsidiary. Cost of goods sold, now we have to reduce it with the 300, which we holding last year, but now we're just releasing it. So the 300 reduction of the cost of goods sold, and the income tax effect, we have to eliminate the 120, which we deducted the previous year. And we're going to see how much is the net income. And with 90% of that net income is going to belong to the parent. The other 10% is going to belong to the non-controlling interest in this case. So once we have that, then we're going to start working with the balance sheet and consolidation of the balance sheet. We're going to see the inventory, parent subsidiary, miscellaneous assets, parent subsidiary. Then we're going to add the liability, parent subsidiary, common shares. Now the common shares, the retained earnings, we're going to get the retained earnings that we calculated on the previous section, which was right here. We're going to go this $19,200. $270, and we're going to add the non-controlling interest from the same calculation, and we're going to end up with the total liability and equity, which is exactly the same with the total assets to balance the entry. Now that was when we're having the upstream. Now, as you can see, the upstream is a little bit more tricky because the non-controlling interest will be affected. Now with the parent selling, then we're going to have a downstream. Now the unrealized profits on the downstreams are deducted from the parent's separate entity income. And non-controlling interest in this case is not affected. And when unrealized profit on the downstream are realized, then they are added to the parent separate entity income. In this case, equity method will be referred as one line consolidation in this case. What's going to happen if we generating losses? Let's pretend we're selling assets at loss. Obviously, that's going to raise a question. Why are we doing that? Obviously, we're trying to flip income from one company to another company. So for that, in that case, we have to check actually if the fair value and if the impairments exist. That will trigger a lot of questions to the auditors and the revenue. If we see transaction between parent and subsidiary, which not generating profit but generating losses. So the intercompany transaction, now the impairment tests of the inventory are usually performed. And when the intercompany losses are eliminated, the inventory is brought back to the original cost, if that's happened. And the inventory on the consolidated should be reported at the lower cost on net realizable, whichever is applicable. And the other thing that we have to understand is that those intercompany transactions does not always consume at the market value. What we're going to do if we're selling land, the inventory, we saw the inventory, how the inventory works on the downstream, first upstream and second downstream. Now let's see what's going to happen if we are having intercompany transaction related to the land and profit. So then the company often redistribute assets among the various corporate divisions. Land and the other non-depreciable assets may be sold into the one division to another division. Now, the selling company will normally recognize a gain or loss on the sale, and the buying company will gonna recognize the purchase of the assets. Now, this cost will obviously be higher than the third-party transactions. So the company must track the original cost and the intercompany unrealized gain and losses. Why? Because we have to record on the consolidated statement. We're going to record the asset on the original cost, and we're going to eliminate any unrealized gain and losses. So the gain and loss on those intercompany sales, we're going to call it always unrealized to the group of the company that we're doing consolidation. Now, if we're treating this entity as a separate legal entity and pay the taxes, Canada Revenue going to treat those one as the normal cost of action, but for the consolidation purposes, we're going to treat it as unrealized gain and losses to the group until the assets are sold outside. Obviously, unrealized intercompany gain has to be eliminated. All the adjustments are made with the objective that presenting the statement of a group of reports, and if the transaction has been between the company that never take place. So in that case, the asset's going to be restated to the original cost. That's why we have to keep the track of what's the original cost of the asset and how much is the unrealized gain and loss. What will be the implication? Implication is that intercompany gain and associated income taxes are estimated on the income statement in the year of sales, and the assets are restated to the original cost. The retained earnings should be adjusted to effect on the elimination of the changes of the asset value. And the next thing is that if we have separate, once we have those separate entities, statement on the cost method, those are the same Same for the upstream, downstream transactions, so there will be no changes in the interpretation of financial statements. The separate entity statements under the cost method are the same as the equity method, except for the investment account, retained earnings account, and equity method income. So the return on equity and the solvency ratio are impacted by intercompany transactions. And consolidated income is the same whether the transactions are upstream or downstream, so that's not going to affect the consolidated net income since we're eliminating all the intercompany transactions. And that's on the chapter, this chapter. Now, very quickly, I'm going to look at the chapter 7, and I'm going to show you something on the chapter 7 that I want you to understand, but that's not going to be tested. Now we cover the inventory and non-depreciable assets, and that's where we're going to stop. That's what the only thing that's going to be examinable. Now I'm not going to examine you on the intercompany profits on the depreciable assets. I'm just going to explain to you, but again, that's not going to be examinable because at this point you have more than enough things to examine you. I'll definitely will examine you on the date of purchase of the subsidiary, how to determine the acquisition differential, how to allocate the acquisition differential when you have 100% and when you have a non-controlling interest. Those are the two that's going to be tested. Those are two questions, 100% owned and the percentage that you own when you have the non-controlling interest. The second thing that they're going to test you is the when we have amortization of the acquisition differential allocation numbers. And the last thing that's going to test you is on the intercompany transactions, and those will be the questions that are going to be tested on the midterm exam, plus the multiple choice questions, obviously. Now, this intercompany profits, depreciable assets, that's not going to be tested, but I just want to go over quickly so you can understand what exactly happened here. On the depreciable profit, so now we have established the basis for the preparation of consideration. First, we're going to do the allocation of the acquisition price. Second, we're going to do the alternatives. Consolidated after the parent uses the cost or equity method, elimination of the intercompany sales and purchases, and elimination of unrealized intercompany profits on the inventory and the land. That's what we did so far. Now, the next thing that will happen is the intercompany profit depreciable assets. Now, for the use of flipping income from one company to another company, the parents and subsidiary usually selling each other depreciable assets. Those transactions usually are recorded at the market value of the assets transferred. Now, the selling company will record a gain, and the buying company will record the asset at the price that they paid, which obviously will be higher than the price that originally bought by subsidiary. Now, for the gain and losses in the company assets, those are unrealized. Why? Because again, we are there within the same umbrella, or they're within the same consolidation. Now, those effects of the gain losses will be eliminated. And objective of the elimination is to report what if transactions is with third parties or never take place. Let's see the example here. So what is the intercompany sales and depreciable assets? Now, the buying company has a different cost than the original cost. Therefore, the amount of depreciation recorded to the buyer's book will be greater. So imagine this. Now the subsidiary buying, let's go with the equipment for $10,000. So the subsidiary can amortize only $10,000 over the life of the equipment. But if the subsidiary sell the same equipment to the parent for $50,000, now subsidiary is going to generate gain of $40,000, which gain will be taxable only 50%, only $20,000, where the parent now have a asset with the original cost 50,000, so the parent can deduct over the life of the asset $50,000 as a depreciation. That's what usually happens. Now the incremental depreciation, which portion that is not based on historical costs, then must be eliminated. So those $40,000 that we adding to the depreciation by selling it, by buying subsidiary buying for 10 and selling to the parent for 50, that additional 40 has to be eliminated. On the consolidated statement, we're going to depreciate only $10,000. This incremental depreciation is later must also be brought as realized the intercompany gain and losses through the process of consumption of the value of the assets. The depreciable depreciation expense, which will remain on the consolidated financial statement after the eliminating the incremental depreciation, is the amount that would have been recorded by the seller based on the original cost. So basically, the depreciation expense is not going to be based on the $50,000 new purchase price from the parent. It's going to be based on the $10,000 original purchase price from the third party, from the subsidiary. Income tax obviously is going to be affected. All the intercompany unrealized gain and losses affect the net taxes. So we have to increase and decrease the depreciable deferred income taxes and upstream gain and losses. So for the allocation of the profit of the unrealized upstream in gain and the tax statement, that's for the non-controlling interest and what the effect is going to be. So let's see a simple example here. What's going to happen if the parent purchase equipment from the third party for $1,000. The equipment is going to have useful life of 10 years. So every year we're going to amortize $100. However, parent immediately sells the equipment to the subsidiary for $1,500. So what's happened here? Parents pay taxes at 40%. So the parent has to pay $200 taxes on the gain of $500 or $200 taxes as part of the sale. So let's see what will be the journal entry. Journal entry will be parent's going to get from the subsidiary $1,500 cash. Parent has to pay income tax expense $200. Income tax payable will be $200. Equipment $1,000 will be written off. And the gain is recorded for the $500, on which gain you're paying $200 taxes. Now, to eliminate unrealized gain, what we have to do is we're going to debit the gain with 500. We're going to add the 200 to deferred income taxes. We're going to eliminate the equipment of 500. And income tax expense is going to be reduced with $200. If the parent using the equity method of the accounting, then we're going to be working with the net amount. Investment income is going to go down with 300, and the investment in subsidiary is going to go down with $300. So as you can see, the first one will be having the original costs under the cost method. The second one, if the parent using the equity method. Now, on the subsidiary, what subsidiary is going to have? First subsidiary is going to have that equipment since the subsidiary bought it, is subsidiary going to have equipment 1,500, and they pay $1,500 cash to the parent. Now they can deduct $150 depreciation expense on these assets over the 10 years. Now, if the parent has not sold the equipment, then the depreciation will be only $100. And since that's the case, on the consolidated statement, we have to reduce the depreciation expense with $50 and reduce accumulated with the $50 in order to eliminate that intercompany sale with $500 profit. What will be the effect on the income tax on the depreciation expense? The effect will be the $20. The $20, the income tax is going to go down. So we have to account for that one too. And this is the example of all the journal entry which are related to the this part of the depreciable assets. That's all I want you to know about the depreciable assets and nothing else. Intercompany bonding, I'm not gonna go over the intercompany bonding, so don't worry about it. And also the affiliated companies, affiliated bonds, I'm not gonna spend time on affiliated bonds. The only thing that I wanted to know is the depreciable assets, and that's all.